Siegel Radio, your home and mortgage connection.
You're listening to Ron Siegel's Home and Finance Show with local and national expert Ron Siegel. Now, here's Ron.
And hello again. Welcome to Ron Siegel Radio. This is the show with no real boundaries as we discuss current events, financial markets, politics, sports, even poking fun at the rest of the media. This is the show that connects the dots of confusion delivered by conflicting media reports. We connect the dots so you know the actions you can take, how your family or business can benefit from current events. Most of all, thank you for joining me. Within every market, there are solutions as well as tremendous opportunities. You just need some trusted guidance. That is my message, and I will be delivering it every day. We have a very focused show. We only chat about items that affect the roof over your head, your bank account, and anything I feel would benefit you. And I'll remind you, if you ever have any home or finance-related questions, I am the consumer advocate looking out for you, and you can reach out to me directly, 800-306-1990, 800-306-1990, or ronsiegelradio.com. Just remember, that's the number you call anytime for assistance. When you call that number, it comes directly to me first. There are operators standing by.
Quiet, numbskulls, I'm broadcasting.
While I do have a great team when it comes to developing a financing plan or plan to save you money, I personally work with you, even if you don't have any needs today. Save this number in your phone for future reference, 800-306-1990, 800-306-1990. And yes, we are celebrating today. Now, Josh, you might have to help me here because I don't get this one. I'm looking at it and it says National Roadie Day. Now, I don't know about this one because it says here National Roadie Day is honoring the road crews that make performances go. When I heard Roadie Day, I was thinking, a cocktail for the road. I shouldn't say that because we obviously don't drink and drive. But I'm not sure where they're going with this one. But it says National Roadie Day is today. Okay, so Josh is telling me that it is just the guys that make the concerts happen. Maybe that's a difference because you're out there in Nevada and Vegas area, and, well, I'm just an old guy. But let's go back to the ones that we can really all agree on because I have beaten anorexia, and today is National Devil's Food Cake Day. Now, I'm looking at the one that we've got here. Lots of chocolate, missing the whipped cream, but that's okay. Lots of chocolate, devil's food cake with more chocolate. You never go wrong with, you never have too much chocolate. I'm just throwing that out there because I am a foodaholic. So yeah, we like that one. And let's see what the markets are doing today. I'm not sure I want to even see what the markets are doing. Maybe we could, going back to some of the prior conversations, can we do a mulligan for today? I'm looking at the markets. The Dow Jones Industrial Average is down 250 points. The NASDAQ is down 256. S&P 500 down 49. Gold down $63 an ounce. The 10-year Treasury is down up 8 basis points, which is not good. And the mortgage bond is down 50 basis points. Ow! So every one of those numbers are not the way we want them to look. Especially if you're thinking about buying a house, refinancing a house, selling, those are not pretty numbers. But, the market is what the market is. And as I tell you all the time, it's all about the strategy. And strategy does beat rate always. Strategy beats rate always. So looking at all these numbers, not exciting. But think about this. And I just did this analysis for a family. It's actually for a retired lady yesterday. We finished up the analysis. And I thought I'd share it with you because it goes back to something that we talk about all the time. Strategy beats rate always. So here's what the discussion really is that lady's 71 years old, retired nurse, fixed income, Social Security income, saved a good amount of money. Her house, she's been renting a house, and now her landlord decides, something, I don't want to be a landlord anymore. I'm moving out of state. No, they're not in California. They're moving out of state. It's another state. And going to sell the house. Well, our 71-year-old retiree loves the house, wants to buy it, but she's looking at it going from $2,100 a month in rent. I said it was in California, to the mortgage price would be about $5,900, $5,500, something like that. Principal, interest, taxes, insurance, the whole 9 yards. So we started looking at it and saying, okay, how much money does she have to put down? That's what she came to me thinking. How much money does she have to put down in order to make this affordable? And we said, well, let's take a look at the numbers. Let me get back to you. We did the analysis. And the idea here is, if you remember, strategy beats rate always. So we said, how about doing 11% down? Strategic number. I'm not going to get into the reason that we did 11%, but 11% down. And we're going to use some of your investment funds to subsidize your payment every month. So your payment is not going to go up. Your out of pocket is not going to change based on after we use this subsidy. And she's like, wow, we can really do this? Well, how long will my money last by this subsidy? I said, well, you've probably got about 35 years of subsidy there. 35 years, 71 years old. That means she could run out of money by age 106. Oh, but wait a second. We forgot something. We forgot to include cost of living adjustments. Now, no, her mortgage won't have a cost of living adjustment, but her Social Security will. So as we increase over the next 10 years of her cost of living adjustment, and we just use a historic number of 2.5%, the reliance on her Social Security increases, the reliance on her portfolio decreases, so she ends up having even more time to live beyond that 106 years old. So what do you think about strategy now? She gets to keep the house she loves. She doesn't have to move. She gets to own it. She gets the appreciation of it. And she has a strategy where it's affordable. And we then said, okay, well, let's pay the landlord his full price, and let's ask him to help with a buy down, rsrlinks.com/buy down. We're going to ask him for help with a buy down so that now she's got an interest rate that's even more advantageous. So we're doing all of these different strategies, all of these different moving parts to help a retired nurse, senior citizen, keep the house she loves and not have to use up all of her savings. Now, I'm going to suggest, in addition, we didn't even talk about this, 5, 6, 7 years down the line, as she's making payments to bring her principal balance down, her age increases, her equity increases, her appreciation increases. Well, then we can go to one of my favorite loan products and see if that makes sense for her. Yes, that would be the reverse mortgage. And that'll help her cash flow even more. So once you get past age 70, in most instances, people are not looking at wealth accumulation. Once you're past age 70, the general thing is people are looking at what is our cash flow position? How does everything affect cash flow? Because at all ages, we live a life of cash flow. Then we looked at her from our two different aspects. We always talk about safety, liquidity, and return. Well, having her money in a safe, secure investments with her financial advisor, that's safe. Having the extra cash in there and not putting it into the house, that's liquid because she can get at it anytime she needs it. Remember, as a lender, lenders do not lend money to people who want money. I'm sorry, they don't lend money to people who need money. They lend money to people who want money. Step off a curb, don't have any money, don't have a job, try and get a loan, it doesn't work. So if you've got all these other strategies going on and you have money, she's got significant assets, well, we don't have to worry about those issues. Her assets are helping to qualify. Remember that now we talk, oh, wait a second. That's eligibility versus suitability. We talk about that one as well. So yes, she's eligible. Is it suitable? We figured out a strategy to make it suitable. We looked at safety. The money's in safe, secure investments, not real aggressive. The money's liquid. And we looked at a return. If a return averages at least about 1 or 2% a year, we're in very, very good shape. And her return gets way more than that. So safety, liquidity, and return, she wins. Suitability versus eligibility, she wins. She wants to stay in the house she loves, she wins. She's near her family, her kids, her brother or sister, she wins. That's where we talk about strategy. That's the difference between a certified liability advisor who looks at all these different aspects and simply somebody where you go online, fill out a form, and they tell you, you don't qualify. Just throwing that out there for you. You are listening to Ron Siegel Radio, discussing your real estate, current events, and the financial markets. When we come back, the smarter buyer doesn't negotiate price. They negotiate payment. Home prices going to fall? We'll talk about that. Here's what nobody tells you about the Fed, your credit card, and your car loan. Estate planning isn't just documents. It's the cheat sheet you leave behind. Cheat sheet. The honeymoon is optional. The insurance audit isn't. Nobody sends a card for that one. All that and more. Reach me anytime. Off-air number 800-306-1990. 800-306-1990 or RonSiegelRadio.com. Facebook.com/Ron Siegel Radio. And if you miss any part of our broadcast, Ron Siegel 1 on YouTube. Ron Siegel, the number 1 on YouTube. Stay tuned. We'll be back in just a few.
Ron Siegel Radio. Your home and mortgage connection.
Are you a veteran, own a home, and need money? The Siegel Lending Team is here to help veterans refinance and get the money they need. The VA 100 lets you borrow up to 100% of your home's value, refinance your mortgages, consolidate credit cards, and lower your payments by an average of $700 a month. And the Siegel Lending Team knows that character means more than a credit score. Call 800-306-1990. That's 800-306-1990. Rate subject to change without notice. Licensed by the California Department of Corporations, NMLS 21037, and DRE number 018694452. You're listening to Ron Siegel's Home and Finance Show with local and national expert Ron Siegel. Now, here's Ron.
Welcome back to Ron Siegel Radio. Within every market, there are solutions as well as tremendous opportunities. You just need some trusted guidance. That is my message, and I will be delivering it every day on Ron Siegel Radio or anytime at 800-306-1990, 800-306-1990. Mortgage Minute today being brought to you by rsrloans.com, rsrloans.com. And every day at this time, OBMMI, they provide the most comprehensive, accurate, timely, and interactive analysis of pricing ever conducted in the mortgage industry. Calculated from actual locked rates with consumers across 35% of all mortgage transactions nationwide. They don't tell us points paid, points received, or the APR. They tell us the number you put in your mortgage calculator to determine your principal and interest payment. You don't have a mortgage calculator? Shame on you. We give them away for free every day. rsrlinks.com/calculators. rsrlinks.com/calculators. Almost 80 illustrators to determine anything you want to know about your financial world. rsrlinks.com/calculators. We had a mixed day on rates yesterday. I don't think it's going to be quite as nice today based on where we are right now. Conventional 30-year fix, 6.545. That was up. Jumbo 30-year fix, 6.598. That was down. FHA 30-year fix, 6.267. That was down. VA 30-year fix, 6.154. That was down. And the USDA 30-year fix, 6.20. That was up. Want our thoughts about the market? Each and every business day morning, go to the community, rsrlinks.com/HBOD. rsrlinks.com/HBOD. That's the Ron Siegel Radio community where we talk about what we think about the market and give you all kinds of different strategies to help you with navigating these markets, which are extremely volatile. S&P 500 right now down 53.22. 10-year treasuries up 8.5 basis points.
Ow!
Yeah, 4.674. And the mortgage bond down 54 basis points. Remember, bond down, rates up. We're looking at about an eighth to a quarter of a percent higher in mortgage rates right now from where they were yesterday, just because of what's going on in the bond market as we speak. Now, does that mean where it's going to end? No. I don't know where the market's going to close. I'm just telling you, this is where the market is right now. Over the weekend, President Trump told Iran they needed to act quickly. That's why we're talking about these markets, or there would be nothing left. Then yesterday, he said the U.S. held off on an attack after several Gulf countries requested a pause as serious negotiations are now taking place and a deal is expected that would be acceptable to the U.S., including no nuclear weapons for Iran. At this point, there is limited credibility in these types of statements, as similar comments have been made before without a finalized agreement, and Iran has not appeared to be fully committed to reaching a deal. Still, this is the latest reported development. Do you believe it? I certainly do not.
You know better than that.
Oil prices higher, WTI trading right now. This is the WTI's West Texas Intermediate, 103.93, down just a little bit. Stocks lower, mortgage binds also down sharply to start the day. 10-year yields continue to move higher, now trading 4.67 as I record this. This is a lot of pressure in the bond market on incoming Fed Chair Kevin Warsh on the U.S. to help get the Strait of Hormuz reopened. Warsh will be sworn in on Friday and is walking into a tough environment. We believe that Warsh will need to show a tough stance on inflation and will not be able to even allude to a rate cut later in the year. Instead, he'll likely have to remove the easing bias from the Fed's statement and at least threaten to hike rates if inflation gets out of hand. The threat alone would likely show the markets that he is not just someone who wants to cut rates and would provide some comfort, causing yields to move lower. The higher rate environment and rise in home values have caused a lock-in effect for homeowners. Additionally, tax rules that have not been updated since 1997 are not helping. Currently, homeowners who have lived in their homes for 2 out of the last 5 years can have a capital gain exclusion up to $250,000 filing single and $500,000 married filing jointly. Tax rules have not been updated since 1997. Wow.
What's the big idea?
Yeah, I mean, that's crazy. Home values have increased by more than 3.5 times since then. There are proposals like the More Homes on the Market Act that would double the exclusions and then index it to inflation, which would allow homeowners to walk away with a lot more money and reduce the lock-in effect. Estimated that 15% of homeowners have gains above the threshold. So this is impacting a lot of homeowners. If something like this act passes, it would be a good thing for housing. And remember, in California, the numbers are probably double or triple the numbers we see nationwide. The National Association of Home Builders released their Builder Confidence Report for May. And while it was better than expectations and increased, it's coming from subdued levels. Overall, the index rose from 34 to 37, which was better than estimates of no change. The internals all rose as well. Current sales rose 3 points to 40. Future sales rose 3 points to 45. Buyer traffic rose 3 points to 25. These figures are all still beneath 50, which means they are in contraction, getting smaller. Here are a few additional stats. 32% of builders cut prices in May, down from 36%. Average price reduction, 6%, up from 5%. Sales incentives, 61%, up from 60%. So you can see, as we've been talking about, lots and lots of incentives going right there. That is the Mortgage Minute, brought to you by rsrloans.com, rsrloans.com. Your Credit Matters segment today being brought to you by rsrlinks.com/debt-free. The Federal Reserve does not set your car loan rate. The Fed does not set your personal loan rate. The Fed does not set your credit card rate. So why does every single one of these rates move the second the Fed opens its mouth? I am Ron Siegel, Certified Liability Advisor, helping families build wealth through strategic debt management. Let me walk you through something most people never connect. The Fed controls one rate, just one. It's called the federal funds rate, and is the rate banks charge each other for overnight lending. That's it. That's the lever. But that one lever moves almost every consumer loan rate in the country. Here's how the dominoes fall. The Fed sets the federal funds rate. Banks then set their prime rate about 3 percentage points above that. And from there, lenders price your personal loan, your auto loan, your private student loan, and your credit card off the prime rate. Now think about what happened between February 2022 and August 2023. The Fed raised the federal funds rate from 0.08% to 5.33%. That's a 5-point jump in 18 months. And every consumer loan in America went up with it. So what does this mean for you today? The average rate on a 2-year personal loan is 11.4%. That's down a little from the high of 12.49% in early 2024, but barely. A new car loan, 7%. A used car loan, 11%. A federal student loan for this school year, 6.39%. 5 years ago, that same student loan was 2.75%. Let me say that again. A college student borrowing money today is paying more than double the rate a student paid in 2022. Same school, same loan, just a different year. And here's the part nobody tells you. The Fed has cut rates a few times in 2024 and 2025, but consumer loan rates have barely moved. Why? Because lenders are slow to lower rates and fast to raise them. That's not a conspiracy. That's just how the business works. So if you cannot control the Fed, what can you control? You can control 3 things: your credit score, your debt to income ratio, and your strategy. Your credit score is the single biggest lever you have. A 740 score and a 640 score on the same loan can be a difference of 4 or 5 percentage points. On a $40,000 car loan over 6 years, that's real money. Thousands of dollars, sometimes more than the down payment. Your debt to income ratio matters too. Lenders want to see your monthly debt payments at or below 35% of your income. Get above that and the rate jumps. Get above 43%, and a lot of lenders will not approve you at all. And then there's strategy. This is where most people miss the point. They focus on the rate. They shop the rate. They negotiate the rate. They lose sleep over the rate. And they completely ignore the bigger picture. Strategy beats rate always. Here's what that actually means. Let me give you a generic example. Say you have a car loan at 7%, a credit card at 22%, a student loan at 6%, and home equity sitting there doing nothing. Your blended cost of debt across all those is probably north of 9%. You can chase a slightly better personal loan rate all day long. But if you not look at the whole picture, you are rearranging deck chairs. What if instead you looked at your household blended interest rate? What if you used the equity in your home and restructured your debt to bring the blended cost down by 2 or 3 points? On $80,000 of consumer debt, that's $1,600 to $2,400 a year every year for as long as the debt exists. That's the difference between shopping a rate and shopping a strategy. So here's what I want you to do. Before you take out your next loan, before you sign anything, before you say yes to a dealer or a credit card offer or a personal loan ad, do 3 things. Pull your credit report and know your score. The easiest way to do that with no hit to your credit is at rsrlinks.com/FICO. That's rsrlinks.com/FICO. And that's a source that does not sell your data. Add up your monthly debt payments and divide by your monthly income so you know your real DTI, debt to income ratio. And look at every loan you have side by side and figure out your blended interest rate. We have a calculator that does that math for you in about 2 minutes. You give it your balances, your rates, and it tells you exactly what your household is really paying. When you have those 3 numbers in front of you, your FICO, your DTI, and your blended rate, you can actually make a decision. Without them, you are just guessing. The credit monitoring, the budgeting tool, the asset tracker, the blended rate calculator are all in one place. You have to go to rsrloans.com. Now, you can go to rsrlinks.com/keysteps. That's rsrlinks.com/keysteps. No cost, no obligation, just the numbers you need to stop reacting to the Fed and start running your own playbook. The Fed will do what the Fed does. You can't change that. But you can change what every Fed decision costs your household. That is the whole game. I am Ron Siegel, your Certified Liability Advisor. Thanks for listening to Your Credit Matters, brought to you by rsrlinks.com/debt-free, rsrlinks.com/debt-free. You are listening to Ron Siegel Radio, discussing your real estate, current events, and the financial markets. When we come back, The smart buyer doesn't negotiate price, they negotiate payment. Estate planning isn't just documents, it's the cheat sheet you leave behind. All that and more. Reach me anytime. Off-air number 800-306-1990, 800-306-1990, RonSiegelRadio.com, Facebook.com/Ron Siegel Radio. And if you missed any part of our broadcast, Ron Siegel 1 on YouTube, Ron Siegel, the number 1 on YouTube. Stay tuned. We'll be back in just a few.
Ron Siegel Radio. Your home and mortgage connection.
Confused about the home buying process? Or curious how much you really know about buying a home? Take the First Home IQ quiz to test your understanding of buying a home. Created by the nonprofit First Home IQ, this 5-minute quiz will give you a score, what you missed, and why. Take the quiz in 5 minutes at rsrlinks.com/FHIQ and find out what you need to know about buying your first home. That's rsrlinks.com/FHIQ.
You're listening to Ron Siegel's Home and Finance Show with local and national expert Ron Siegel. Now, here's Ron.
Welcome back to Ron Siegel Radio. Within every market, there are solutions as well as tremendous opportunities. You just need some trusted guidance. That is my message, and I will be delivering it every day on Ron Siegel Radio or anytime at 800-306-1990, 800-306-1990. Real-time real estate segment today being brought to you by rsrmoney.com, rsrmoney.com. Almost 40% of, the real-time real estate segment today being brought to you by rsrmoney.com. Almost 40% of home sellers say they plan to offer concessions this year. That's up from 30% last year. And if you're a buyer, that is your opening. The question is not whether to ask. The question is what to ask for, because the wrong ask can leave thousands on the table. I am Ron Siegel, Certified Liability Advisor, helping families build wealth through strategic debt management. Here's what just hit the wire from Realtor.com. Nearly 40% of potential sellers say they are willing to offer concessions in 2026. A year ago, that number was 30%. That's a real shift. Concessions can show up in 3 flavors: a price cut, sellers covering your closing costs, or money put toward repairs. Most buyers hear that and go straight for the price cut. It feels like a win. The number on the contract is smaller. You tell your friends you saved 20 grand, and then you sign the loan papers and realize the price cut barely moved your payment. Let me show you the math, because the math is where the real strategy lives. Picture a $650,000 home. You negotiate a $20,000 price cut, great headline, but spread across a 30-year mortgage. At today's rate, that price cut saves you somewhere around $100 a month. Useful, not life-changing. Now picture the same $650,000 home at the original price. Instead of asking for a price cut, you ask the seller to put $20,000 toward a permanent rate buy down, not a 2-1 buy down, not a temporary gimmick that resets after a couple of years. I rarely recommend those. I'm talking about a permanent life of the loan rate buy down. That same $20,000 can drop your payment by $200 a month or more every single month for as long as you own the home. Same seller money, same out of pocket for you. Twice the monthly savings, and those savings stack year after year after year. If you want to see exactly how this works side by side, go to rsrlinks.com/buydown, rsrlinks.com/buydown. That page lays out the strategy in plain English so you can see the math before you ever write an offer. rsrlinks.com/buydown. Now, if you are listening to me from California, double everything I just said. The median home in our market runs closer to $1.3 million. So we are not talking about a $20,000 concession. We're talking about $30,000, $40,000, sometimes more. And the gap between the lazy ask and the strategic ask gets even bigger. So what does this mean for you? It means before you write an offer, you need to know which concession actually moves the needle. A repair credit might be the right play on a home that needs a new roof. Closing costs might be the right play if you're tight on cash to close. But for most buyers I work with, the permanent rate buy down is the move that pays you back for the next 30 years. This is the eligibility versus suitability conversation I have with every client. A lot of lenders can tell you what you are eligible for. Very few will sit down and tell you what is actually suitable for your situation. That is what a certified liability advisor does. Strategy beats rate always. Here's the bottom line. Sellers are more flexible than they have been in years. That's a gift. But a gift you do not know how to open is just a box on the table. The right concession ask, structured the right way, can save you tens of thousands of dollars over the life of your loan. The wrong ask saves you $100 a month and a story to tell at the barbecue. So before you sign anything, before you even write the offer, go to rsrmoney.com, and you can actually see valuations of the properties. You can also go, and I'll go to rsrlinks.com/buydown, and I walk you through the concession strategy that fits your price point, your market, and your long-term plan. Sellers are ready to negotiate. Let's make sure you're asking the right thing. And again, the rsrmoney.com has great information for you. I am Ron Siegel, your certified liability advisor, helping families build wealth through strategic debt management. Thanks for listening to the Real-Time Real Estate segment brought to you by rsrmoney.com, rsrmoney.com. Borrow Smart segment today being brought to you by rsrwealthbuilder.com, rsrwealthbuilder.com. Lee Marvin once joked that the second people saw his face on the movie, they knew two things. He wasn't going to get the girl, and he was going to get a cheap funeral before the picture was over. Funny line. Uncomfortable truth. Almost nobody wants to sit down and plan their own funeral, and yet most of us have very specific ideas about how we want to be remembered. I am Ron Siegel, certified liability advisor, helping families build wealth through strategic debt management. Today, I want to talk about the one piece of paper that may matter more than your will. It's called a letter of instruction. A letter of instruction is not a legal document. Your will is the legal document. Your trust is the legal document. Your letter of instruction is the cheat sheet that helps your family actually use those legal documents when you're no longer around to answer the phone. Think about that for a second. Your spouse, your kids, your executor, they show up the day after you are gone, and they have to find everything: the will, the trust, the deed to the house, the title to the car, the life insurance policy, the password to the laptop, the key to the safe deposit box, the login to the brokerage account. If you have not written it down, they are guessing. And guessing during grief is the worst time to guess. So what does this mean for you? Let me walk you through what actually goes in a letter of instruction. It is simpler than you think. Number one, the location of every important legal document: your will, your trust, your insurance policies, auto titles, property deeds. Tell them where these things live: a fireproof safe, a drawer in the office, a binder on the bookshelf. Be specific. Number two, a list of financial assets: checking accounts, savings accounts, brokerage accounts, retirement accounts, pensions, profit sharing plans. Include account numbers, include the institution, include the login or PIN or password, or at least tell them which password manager you use and how to access it. Number three, the location of your latest tax return and your Social Security statement. The executor will need both within the first 90 days. Number four, safe deposit boxes: which bank, which box number, where is the key? Number five, funeral wishes, burial or cremation, the location of the cemetery plot deed if you already own one, the hymns you want sung, the speakers you want to speak, the Bible verse you want. None of that is legally binding, but your family will be grateful you told them. Number six, a contact list: the people who should be called when you are gone: your CPA, your attorney, your financial advisor, your mortgage advisor, your clergy, old friends who would want to know but might not see the obituary. Here's what nobody tells you. The letter of instruction is also where you protect your family from household financial chaos that almost always shows up after a death. Real world example: a family loses dad, dad handled the mortgage. Dad handled the property tax payment. Dad handled the home equity line that was attached to the rental property. Mom does not know which lender. Mom does not know which login. Mom does not know if there is an escrow refund coming or a balloon payment coming. Now, mom is dealing with grief and a stack of statements she's never opened. A letter of instruction prevents that. One page, lender name, loan number, payment amount paid, auto pay, yes or no, escrow, yes or no, done. This is the kind of detail that lives in the conversation I have with families every week, because strategic debt management is not just about what you owe today. It's about how the people you love handle what you owe or what you own when you are not the one driving anymore. Strategy beats rate always, and nowhere is that more obvious than when a family inherits a house, a mortgage, a HELOC, and a brokerage account and has no idea where to start. So what do? You do not need a lawyer to write a letter of instruction. You write it in your own voice. You make it personal. You update it once a year. You tell two people where it is, your spouse and one other trusted person. That's it. And if you want help thinking through the estate side, the trust, the will, the beneficiary review, the partner referrals to the professionals who actually do this, go to rsrlinks.com/estate. That's rsrlinks.com/estate. I have a network of estate planning partners, and I refer my clients to every week, and I'm happy to point you to the right one based on your situation. The letter of instruction is a gift you give your family that will not even realize is a gift until they need it. And by then, you'll not be around to hear them say thank you. So write it, update it, tell them where it is. I am Ron Siegel, your certified liability advisor, helping families build wealth through strategic debt management. Thanks for listening to the Borrow Smart segment, brought to you by rsrwealthbuilder.com, rsrwealthbuilder.com. You are listening to Ron Siegel Radio, discussing your real estate, current events, and the financial markets. When we come back, our home price is going to fall, and the honeymoon is optional. The insurance audit isn't. Nobody sends a card for that one. All that and more. Reach me anytime. Off-air number 800-306-1990, 800-306-1990, or ronsiegelradio.com, facebook.com/Ron Siegel Radio. And if you miss any part of our broadcast, Ron Siegel 1 on YouTube, Ron Siegel, the number 1 on YouTube. Stay tuned. We'll be back in just a few.
Ron Siegel Radio. Your home and mortgage connection.
Do you know a homeowner experiencing divorce? Do you know a real estate reference and the divorce decree could cost tens of thousands of dollars? A certified divorce mortgage planning and real estate report could save you thousands of dollars, and it's free from your local certified divorce lending professional. Reach out to Ron today. RonIsMyLender.com. Again, RonIsMyLender.com. Licensed under NMLS 217037, Equal Housing Lender.
You're listening to Ron Siegel's Home and Finance Show with local and national expert Ron Siegel. Now, here's Ron.
Welcome back to Ron Siegel Radio. Within every market, there are solutions as well as tremendous opportunities. You just need some trusted guidance. That is my message, and I will be delivering it every day on Ron Siegel Radio or anytime at 800-306-1990, 800-306-1990. Borrow Smart segment today being brought to you by rsrwealthbuilder.com, rsrwealthbuilder.com. You got married. Congratulations. Now, nobody tells you that the wedding is the easy part and the boring paperwork sitting in 2 different filing cabinets is what actually determines whether year 3 feels rich or feels stretched. I am Ron Siegel, certified liability advisor, helping families build wealth through strategic debt management. And today we're going to talk about the part of the honeymoon nobody Instagrams: insurance. Before you click away, hear me out, because I am not here to sell you a policy. I do not sell insurance. I refer my clients to trusted agents who do this for a living. What I do is sit across the Zoom screen from couples and help them see how their loans, their assets, and yes, their insurance all fit together as one financial picture. And you just got married, that picture changes. And when you just got married, that picture changes overnight. Let's walk through it. Auto. Most couples walk into marriage with 2 separate auto policies, 2 deductibles, 2 renewal dates, 2 companies billing you. Here's the good news. Married drivers are often eligible for lower rates than single drivers. Call both companies, ask for a combined quote, and compare. You might find 15 to 20% in savings just by combining what you already own. That's real money. Home. Maybe you start as renters, maybe a condo, maybe a first house. When you buy, your lender requires homeowners insurance or condo insurance. But here's the question most newlyweds never ask. Does my policy cover replacement cost or actual cash value? Because if a fire hits a 10-year-old roof, actual cash value pays for a 10-year-old roof. Replacement costs pay you for a brand new one. Same monthly premium difference, completely different outcome when something goes wrong. In California, this matters double. Our home prices run roughly twice the national average. The asset you are insuring on day one of marriage in California might be a $1.3 million house. You not want to find out at a claim time that you underinsured the biggest thing you own. Health. You now have a choice. Stay on two plans or put one spouse on the other spouse's plan. Run the numbers, compare premiums, deductibles, the network, the prescription coverage. Sometimes one employer's plan is so much better than combining saves you thousands a year. Sometimes splitting is better because of network access. The point is to actually look. Most couples do not. Disability. This is the one nobody thinks about and the one I see destroy more families than any other. When you got married, you probably tied your mortgage to two incomes, your car payments, your lifestyle. Now imagine one of you cannot work for 6 months. Disability insurance replaces that income so you can keep paying the bills designed for two people. If you only carry it through work, find out what the benefit actually pays. A lot of group disability policies cover only 60% of base salary and do not include bonus or commission. Life. Central to any marriage is a concern for the other person's future. If one spouse passes, can the surviving spouse pay off the mortgage, cover the cash flow, and keep the life you built? If the answer is no, that's what life insurance solves. Term life is cheap when you are young and healthy. Wait 10 years and the saved coverage can cost 3 times as much. Age and health drive the price. So does the type of policy. Talk to a licensed agent before you assume you cannot afford it. Most newlyweds can. Liability. Here's the one nobody mentions at the wedding. As you start building wealth together, you also start building a target, a car accident, a pool accident, a dog bite. An umbrella policy sits on top of your home and auto and adds an extra $1 million or $2 million of personal liability protection for around $200 to $400 a year. For the cost of one nice dinner, just a month, you protect the entire foundation you're building. Extended care, probably not on your radar at age 28 or 32, fair, but have the conversation with your parents because the cost of a parent's long-term care can roll downhill onto the kids fast. A 90-minute conversation with mom and dad now can save your marriage 10 years from now. So what does this mean for you? It means the first year of marriage is not just about merging Netflix accounts. It's about merging risk, auto, home, health, disability, life, liability, extended care. 7 categories, 1 household, 1 picture. And this is where strategic debt management comes to all of it. Because your insurance decisions shape your liquidity. Your liquidity protects your home. Your home is your largest asset, and your largest asset is sitting on top of your biggest liability, which is your mortgage. None of these pieces are separate. They're the same financial picture. Remember, strategy beats rate, always. And a couple with the right strategy and average rates will outbuild a couple with the lowest rate and no plan every single time. Here is your homework. Go to rsrlinks.com/keysteps. That's rsrlinks.com/keysteps. This is the tool I give my clients to track their household budget, monitor their credit as they prepare to buy a home, and see all their assets in one place. It is built for exactly this moment. You just merged 2 lives. KeySteps helps you see what that actually looks like on paper. rsrlinks.com/keysteps. And if you want a second set of eyes on how your mortgage fits into all of this, I do 15-minute Zoom consultations, no charge, no pressure. I'll refer you to my trusted insurance agents, my trusted estate attorneys and partners, and we'll look at your full picture together. I am Ron Siegel, your certified liability advisor, helping families build wealth through strategic debt management. Thanks for listening to the Borrow Smart segment, brought to you by rsrwealthbuilder.com, rsrwealthbuilder.com. I think I have time for a real-time real estate segment brought to you by rsrmoney.com, rsrmoney.com. Our home price is going to fall. It's one of the biggest holdups some buyers have right now. What if I buy and home prices go down? With everything in the news, the concern makes some sense. No one wants to make a big financial decision at the wrong time, but here's what's important to know. You don't want to get hung up on a few places seeing slight declines right now. When you zoom out and look at the full picture, home prices usually rise over time. What the data really shows, take a look at the visual below, or that I'm going to share with you. If you're looking at ronsiegelradio.tv, any of our socials, or the ABC News and Talk, AM 1490 and FM 98.1 video feed. It uses data from Case-Shiller and Bilello to show how home prices have changed year by year, going all the way back to the 1950s. Here's the key takeaway. Outside of the housing crash, home prices have either held steady or increased in just about every year for decades. Look at that chart. I mean, you can see the green on there. What's it, 6 years out of 75, it looks like? That's a remarkable, consistent track record, and it shows something a lot of headlines miss. While short-term shifts can happen, it's the long-term gains that really matter. There are a few core reasons prices usually go up each year. There are always people who need to move, people who need a place to live, and that demand will never fully go away. It may ebb and flow, but some will always have to move as big changes happen in life. Diamonds, diapers, death, divorce, they're all there. There still aren't enough homes for sale. While the number of homes for sale has grown nationally, there's still an undersupply based on how many people want to buy. That keeps upward pressure on prices. Inflation has an impact. Over time, the cost of goods, including homes, naturally increases. That pushes home values higher. It's easier to get caught up in what might happen with home prices next month or next year, especially if you're a first-time buyer and you're feeling a little anxious about making such a big financial commitment. But the big picture is clear. Prices usually rise. That doesn't mean prices will go up every single year in every market, but real estate is local, and there can be short-term ups and downs. We're seeing that in some places right now. You can even see it in the few annual dips in the visual that we just showed you. But historically, the declines have been temporary. That's why it's generally recommended to buy a home only if you plan to stay for a while, typically at least 5 years. That's normally enough time to see your house grow in value, and it's enough so you can ride out any short-term changes in the market. Because when you can do that, something powerful happens. Those rising home values grow your net worth, and by extension, help you build wealth. The right decision isn't about timing the market perfectly. It's about making a move that works for your life and staying in it long enough to benefit from the bigger trend. Bottom line, home prices have a long track record of going up over time, and that's why buying a home is generally considered a safe long-term investment. That certainly doesn't mean you have to buy now. You should only move when it makes sense and you plan to live there for a while. But if you're interested, let this reassure you. If you want to talk through what home prices are doing in our market, your goals, your timelines, let's have a quick conversation. That is the Real-Time Real Estate segment brought to you by rsrmoney.com, rsrmoney.com. And as always, I ask, set that first radio preset button to come back here and join Ron Siegel Radio, where we only speak about items affecting your house and your bank account. Thanks to all our sponsors. A big thanks to Josh and Sean for engineering us today. And of course, a special thanks to you for spending a little bit of your day with us. That's all for Ron Siegel Radio. Again, if you have any questions or to meet any of our guests, call me anytime, 800-306-1990, 800-306-1990, or ronsiegelradio.com. And remember, make a lot of money so you can help a lot of people and have a lot of fun. Have a great day. We'll talk to you next time on Ron Siegel Radio.